this is Craig Haskell with Haskell Value Real Estate Investor. You're listening to another exclusive interview with the leading authority in the opportunistic and value real estate investing space. Today we are in Evanston, Illinois, across the street from Northwestern University, speaking with the leading expert on how to generate high-risk adjusted returns by repositioning multifamily properties to a niche tenant base. Our special guest today is Bill Bennett, co-founder and principal of Iconic Development. Iconic is a real estate investment firm that specializes in buying C multifamily properties in A locations within a strategic identified submarket, and then they reposition their properties to a niche tenant base such as students, echo boomers, seniors, and the Hispanic market. This strategy has allowed Bill to consistently generate high returns for his investors, where average rents are 25% higher than his competition, even in today's tough market. In this interview with Bill, you will learn the attributes a niche property must have before buying, the competitive advantage his properties have over the competition, the value-enhancing strategies Bill employs to create higher returns, the matrix Bill uses to identify markets where his niche investment strategy works best, which niche strategy has worked out best for him, the biggest challenges to using his unique repositioning strategy, how much Bill spends on capital upgrades to differentiate his properties, how long it takes to reposition and stabilize his properties. If you are a multifamily real estate investor looking for new ideas on how to increase your risk-adjusted returns, then you should slowly go through this interview. There are many nuggets of information that can be applied to your investments, even outside the multifamily platform. All right, Bill, you're a true value investor on many fronts. Tell us about your overall investment strategy and how it's different.
Well, our investment strategy is to invest in demographically driven niche apartments. And so for what that means for us is customer bases that are unique and underserved, like students, like seniors, and like Hispanic families. And so by going after a precisely targeted group, you can better understand your customer base, what they want, and better cater the real estate product and the operating program to them. And so what we feel like is in those niche apartment areas, other people are scared of it. And also, if you really learn your customer base, you can provide a better differentiated product that outcompetes your competition. You know, while you're competing for a smaller slice of the pie, our lease signing rates are typically 2 to 3x what our competitive properties are, because you know, a normal apartment seeker goes out and looks at 5 apartments in their search. And so, you know, kind of by definition, about 20% of the time they're choosing your apartment. Well, we usually get, 40 to 60% out of our overall kind of incoming ratio.
So you're buying the properties and you're positioning them towards a certain niche, a certain tenant base. Mm-hmm. And then you create this environment around the property and then you market that in the marketplace. And your message is met with those types of renters that fit the demographics that you're going after.
Yeah, that's exactly right. So, we're just a highly targeted apartment offering, similar to what the hotel industry evolved to in the late 90s and the early 2000s, which was the boutique hotel concept took off, and the people that did it well, they really found it to be a great niche. And we're seeing, by applying those same type of concepts to apartment, i.e. high design, better amenities, a better service and operating program, we think that it blows the doors off of the beige carpet, white wall apartment that's like eating a box of rice out of a takeout box with a glass of lukewarm water. We think of our apartments as jasmine rice with green curry prawns, a mojito, and a side of sriracha. So
awesome.
Yeah.
So let's say you have a grocery store and at a Safeway grocery store, and they have one aisle that has, or maybe half an aisle that has Hispanic foods. You basically have taken a whole entire, created a whole store, Hispanic store that has everything versus just one small aisle. So you get seen more than everybody else.
Yeah, that's exactly right. And so, within the Hispanic apartment space, we've done a lot of surveying of the target customer base, the different assets, visited 120 assets and tried to see what's working and what isn't. And so our operating program includes an outrageous playground for the kids. It's the number one amenity the decision maker is looking for, which is the Hispanic mother. And so, we have an after-school program. We put in, really vibrant colors that appeal to that target demographic, and do English-Spanish websites, English-Spanish leases, and hire and maintain a staffing that's consistent with the target customers.
What other tenant niches do you do other than the Hispanics?
Students are our largest demographic that we serve, and so we've got we're the largest landlord around Boise State University. We're at the University of North Texas and Texas State, and we have been targeting. We spend a lot of time doing research into the demographic, and we have ranking models that rank the different markets for attractiveness. And so what drew us to those markets out of Chicago was they have growing gaps between supply and demand. And real specifically, most of them have underrepresented kind of professional ownership in the Class C apartment space. So what we're really doing in that market is we're finding C product in an A location, and we're rehabbing it to earn B rents.
To a certain demographic group.
Yeah, to a certain demographic group. And so the students have been, that business is firing on all cylinders. As the economy's been tough, it seems like kids are staying in school longer. The demographics of it are already super strong if you're in the right states, metros, and markets. And so that business has been just a tremendous growth opportunity for us, and our investors in those projects are calling us asking if there's more.
What market are you in? What states?
So we're in student apartments. We've got 8 apartments in the state of Texas, and then we've got 3 apartments in and around Boise State in the state of Idaho. And so we're primarily focused on those states and metro areas and universities that have very high growth and not much in the way of new construction.
As you look forward, what areas would you like to grow into or expand?
I'm flying to Virginia tomorrow to look at some student assets. North Carolina is a nice market for student assets and Hispanic assets. And, we've been to Utah a number of times and Colorado a number of times. And Arizona is also a great student market.
Can you give us an example of a property you've repositioned?
We bought a 100-unit complex in Denton, Texas, and rebranded it as Vintage Pads and went after the student market at the University of North Texas in a very defined and targeted way. And through that, what we found was, it was a C asset, but it was in a great location with great frontage. It was 2.5 blocks from the university, and we were able to, basically change the exterior appearance, redo all 100 interior units with our green upgrade program, and we were able to take NOI from about $425,000 to just over $1 million annualized right now, and this is over the last 19 months. So a pretty terrible time in the real estate business, and it just goes to show you that if you're really focused and you find the right assets that you can do something with, and focus heavily on executing, that you can create value through any market cycle.
So the real difference here is you're buying something that is a good price in the right location for the right demographics, and you're just catering towards them because that's phenomenal.
Yeah, so we think about value investing as, basically you're trying to buy wholesale, and then, that's your capturing value at the beginning during the purchase price, and then we're able to do something with it to create value, and then you're going to capture it in the form of a refinancing and a sale, and paying some great cash dividends. So that project's in the kind of high teens cash on cash returns, in under 2 years, which is better than we thought we'd do. But part of the really great thing about catering to niches is you can push the envelope. So we were able to do some pretty neat things at that asset to help increase value, like converting storage units into actual leasable units. We saw that there was basically no product in the market for the very high end, so we created several penthouse units that get, where we're able to boost rents $1,000 a month. And, they were the first units to lease. And so there's always gaps in the marketplace, and if you can identify those gaps, you have the chance to serve them profitably.
What are some big challenges you've had repositioning these assets?
Yeah. The biggest challenge we usually face is the same type of renter who rents a product at $500 is different than the one that rents it at $625. And so, within our student housing business, we see about 80% of the tenants turnover during the reposition. And, even though you're providing a superior offering and better quality, it's just a different renter profile. And so that puts intense pressure on the leasing and the marketing, to sign that many leases, because you're essentially, your residents are either moving out because they choose to, or, in some cases, if your renewals are strong in the second year, you're forcing evictions, so you can complete your business plan.
So the challenges as far as that transition from the old tenant to the new tenant base.
It is, and part of that is, when you go to reposition a property, you're creating a new entity. You're trying to take the old thing that maybe had, a certain stigma and a certain type of tenant and a certain, price range, and you're trying to make it something newer, better, and more attractive to a higher paying, higher credit tenant. And that's really the art of it, is being able to manage that process. It's a lot easier strategized than executed.
So do you turn units with the idea of forced evictions, or do you just turn them as tenants move out?
We put a limit on how many units we will renew in a given month, and so if we hit that cap, then we do either force them to sign into an upgraded lease, or we do not renew. And so the business plans we've had are focused on creating value in a 2-year, 18 to 30 month period, and part of that necessitates transitioning some tenants out.
What matrix do you use to identify favorable markets for your investments?
Yeah, market selection is one of the biggest things we think about. So, as a person that's looking to outperform, and as a company that's looking to outperform, market selection's at the heart of the issue. And so what we're looking for are markets that, have strong demographics, first of all, and then, particularly within the student housing space, they have growing demand without the same growth of supply, and where we see in kind of underserved niche and the kind of product we can get at. We primarily focus on repositioning C assets in A locations, and so some of the newer markets don't have that, but most of the university markets out there do.
It seems like you go to greater extents to tailor your properties than other competing properties. Is that fair?
Oh, it absolutely is. I mean, we're trying to be at the cutting edge of targeting to the tenants we want. And what that means is you're taking a risk. So a lot of people walk in and absolutely love it, but some people walk in and they say, this isn't at all for me. This feels like it's just different. I like the white wall and boring apartment and put my own stuff in it, and so we risk offending a few people at the opportunity to impress a whole bunch.
Well, give us a flavor of what it looks like in a unit that you've redone. Some of the colors, maybe some of the amenities, and so forth.
Sure. I'll just pull up a few pictures too.
Okay.
And one of the things we see is when we're buying assets primarily from mom and pops is that they don't have great design, they don't have a website, they often don't have any kind of online marketing strategy, and so that's a major portion of how the student tenant base picks their properties. So an example of what you see in, we'll just stay on the Denton, Texas project, is you walk in and the first thing you see is artisan stained concrete flooring. Well, replacing carpet's an environmentally friendly thing. Not only that, but you don't have to replace the carpet all the time in the turns. It looks better and gets higher rent than the competing properties, and is just really great from an owner's perspective because the units don't gain the same smells, and you can turn them faster. So you're creating cash flow, both on the revenue and the expense side. And then you see, a vibrant color wall. We tend to focus on making a splash when folks first move in. Some great countertops or some designer backsplash tile. We usually end up putting some some beautiful lighting systems in, and just focus on modernizing the apartment and making it feel and look basically like the generation we're targeting wants.
Some of the interior improvements that you do with the pictures you just showed us, is that done in-house or do you contract that out?
It's mostly our vision, and so we're a true development firm. There's 5 employees, and we have about 300 folks that were working with us this summer, and a lot of those folks have traveled around the country and do work exclusively for us. But a lot of it we subcontract out, and we act as the developer and owner.
What types of attributes, like features, size, location, price, etc., that does a property need to have so it fits within your investment strategy?
Yeah, we love the $5 to $15 million apartment space. It's too big for the mom and pops, too much money, too much skill, and it's too small for the private equity funds and the REITs, and too much work for them, frankly. And so we get to pay to do that heavy lifting. We target C assets and A locations, and A markets that can be repositioned up a notch. And what that typically means is we're able to raise rents 20 to 25% on average across the units through our rebranding, repositioning, unit interior rehab. And we've been successful doing that in over 800 units now. And it's gone really great.
Do you prefer properties that have higher vacancy so that it's easier to get in and turn units?
Yeah, we're actually the opposite. So we're trying to buy assets that are 90 to 100% full, and even if you did nothing, it would be a great investment. So that limits our investors and our downside risk. And then, another thing about buying an asset that's full or nearly full is you pretty much know the rents are below market if it's in a great location. We tend to purchase the 70s and 80s built product, and what that means is they usually have larger floor plans, and so you've got a better palette to work with, and they're in usually better locations, so you're not really taking the market risk. You're not on the fringe of a society. You're close to the demand drivers. You're betting on a proven market, but typically there's severe deferred maintenance and a lot of TLC and hard work that it takes to bring it up a notch.
So you put money into the properties per your business plan. How much do you spend per unit, would you say?
It ranges from $10,000 to $15,000 on average, depending on the property age and condition. We've had some units that are, we've put $35,000, $40,000 in, where we've added bedrooms and bathrooms. We've built some new units, converted some units out of storage shed, combined units, taken units apart. A lot of the benefit of dealing with the 70s, 80s vintage products is you have very large units, so there's creative things that you can do with them.
How about washer and dryers? Is that ever an issue when you're out in the marketplace?
Mm-hmm. Some of the units have washers and dryers in them, some don't. And overall, what you're really trying to do is, focus on the fundamental, competitive landscape in the market and try to see how you can differentiate your product. So some of your product may cater to, 19 and 20-year-old girls. Some of it may cater to upperclassmen males, and you're just trying to match the amenity, the operating program, and the real estate look to the target audience. So even within the demographic, which is very focused, we try to even take it down a notch and really understand who's living there and why.
So you're buying property that typically has low rents.
Mm-hmm.
You're upgrading the property with improvements, and you're niching it towards a certain tenant base. What types of rent increases do you get on a percentage basis compared to your competition?
The competition shifts throughout the life cycle. So when we walk in, there's one competitive landscape, which is typically the other mom and pop apartments with no amenities and kind of bare bones look and feel at a pretty low rent level. And then what we usually end up competing with is the much newer product that has great amenities but is in typically a much worse location and has smaller units. And so we end up trying to have the value proposition of we've got units that are bigger, closer, and cheaper, but they're still pretty cool. And they're maybe 20% below the top of the market rents, so they can't come down and compete with us. And we just kind of gradually have been stealing their tenants and doing a great job in this economy.
So you're 20% below the top A properties, the newer properties, and the lower properties How much would you be above them, would you say?
20 to 25%. And so, particularly in Texas, there wasn't a lot of product built between the mid-'80s and 2000 due to the oil bust. And so there's not a lot of B product out there in the market. And so what we're kind of doing is taking C product and really pouring money into it to create that gap that's out there in the marketplace.
How long does it typically take to renovate a property from a construction standpoint as well as to get it turned, stabilized?
The student properties we underwrite to go through 2 full seasons. And so, really that's one of the main risks in the student housing business and the development of the repositioning space is you can't miss the window. If school starts and you haven't finished, you're dead. Those units are going to sit vacant for a year. And so, there's a high focus on execution during the summer months, and you have to ramp up and just be incredibly efficient and effective in planning, scheduling, ordering materials, project managing. So it's usually a 2-year business plan to get through the rehab portion.
And how long would you typically hold an asset?
All our assets have been underwritten as a 4 to 5 year business plan. And so we're looking to get in, create value, stabilize an asset, and then capture it in the form of a sale. And so Iconic as an entity is really only meant to create that value and share in it. Because kind of after you're able to reposition up a notch, then it's pretty much back on the CPI rent growth line, and you've created the value, and you could sit around and just get cash dividends, but we'd like to recycle our equity into more projects and try to do it again.
Are there other types of rent additions that you can get based on your tenant niche?
We've toyed with the idea of converting or adding storage units to it, and so what we see is, typically when you're in areas around universities, there's not enough storage and there's plenty of people who look at it, and so it's a natural add-on to apartments that I think is a great opportunity that we're not fully capturing right now. We've added fees for parking at some units and successfully increased rent there, and we've also been able to implement RUB systems and pass-through utilities. One of the things that has helped the renter pool and also the income statement has been allowing pets in. That can be a double-edged sword, but those are the kind of apartment opportunities we see and have had good luck with.
Now, running these types of properties that are focused on a niche, does it cost more to operate these properties?
I think it does. I think it does cost more. So through our green rehab program, we've been able to cut the utilities, cut the management fees, cut some of the marketing expenses, but I think the operating program tends to be a little more expensive, and what we've unfortunately seen is we've seen our taxes increase in most of the time. So our reward for going to a community and investing, creating jobs, making it a better place to live has been a tax increase. It's kind of a perverse incentive system where property owners that let their assets degrade are rewarded, and people who invest to create jobs and better the environment are punished, but that's a different conversation.
What are some of the property management challenges that you have? I'm assuming you job out your management services?
Yeah, we have a third-party property management we hire, and we've hired and fired many firms already. And so, there's an inherent conflict of interest between owner and property manager, and you do your best to limit those through contractual, through interviewing, and through asset managing. But the most difficult challenge is always just making sure that conflict of interest doesn't degrade your investment too much.
How about the concepts that you were trying to roll out, the business plans, to getting them to buy into it?
Yeah, that has been tough too, and that's been the root cause of some of the property management firms that haven't maintained a relationship with us. Property management firm is just really a function of the people, and so if you're able to go in and show the people the vision, quickly transform the exterior of the property, perhaps produce a model unit that can really sell, then you can get them on board. If it just becomes a lot of talk, people have a hard time visualizing what an asset could be, which is why there's the opportunity for value-added redevelopers, but it's hard. And so the best results we've had is by showing people what we can do, and then they'll buy into the vision. But every day is a challenge to keep people on board.
What kind of feedback have you gotten from the local community on your niche markets?
The neighborhood, the neighbors love it because you're taking something and you're making it look new and nice again. And so we've had good results with the neighbors, and nobody likes the construction noise and the high traffic during the rehab season. And so you're just trying to maintain a professional standpoint to your tenants, the neighbors during that. But when people see improving something, they're usually very friendly about it. The local government's been a mixed bag. Most of them are friendly, and when we probably made a few mistakes there. And what we've learned is it's key to get in there, tell them about your vision, what you're trying to do, and why. And when people understand you're investing, creating jobs in the community, and making their environment a better place, they're usually on board and supportive. But we are, by definition, out-of-towners, and so you can get treated as an out-of-towner unless you really go in and court the local government folks, and explain to what they're doing, and ask for their opinion too, and respect it.
Where do you see your company, Iconic, going over the next 5-10 years?
Our widgets that we're making are proven to be successful, and so we're creating and developing these brands to serve niche demographics. And we feel like there's significant growth opportunities within that to buy more assets and link up with investors that that share the same view of the world, looking for high risk adjusted returns. So I think we will grow through acquisition and rehab, and try to scale up our investment portfolio.
I hope you enjoyed this interview. For more information on Bill Bennett and Iconic Development, please call them at 847-869-2482 or visit their website at www.iconicdevelopment.com.